afternoon, everyone. I know we're in that lull period after lunch, and after hearing all the panels this morning and people talking, capital markets is probably not at the top of everyone's list, but we thought it would be helpful for people to hear just a little bit about the way forward and for both private and public companies. My name is Steve Hollander. I'm a partner, corporate partner at Watson, Farley & Williams, dealing with capital markets and among other things. Let me just very briefly introduce the rest of our esteemed panel, who most of you probably already know. Christa Volpicelli, Managing Director at Citi. Karl Staubo, who is the Head of Shipping at Clarksons, Platou, Securities. Todd Wilson, who is the Senior VP of Maritime Investment at Jefferies. And then Eric Schless, Managing Director at Wells Fargo. We have folks who are obviously very experienced and know the market quite well, and we thought it would be helpful just to really kind of find out exactly what they thought about the market. So with that, I guess I'll just open it up and say, with the easy questions before we get to the hard ones, and that is, well, what is your current impression of the capital markets for shipping companies? I guess Christa, we'll go down the line on this one.
That's the easy question?
Yeah. There you go.
Okay, great. I would just make a general statement that the capital markets for any company in any energy-related sector are very challenging right now. There's only been 4 IPOs in the US this year, and they've all been in the biotech sector. So we've seen a lot of volatility. I think there were a lot of folks, both on the buy side as well as from the listed company side, who were hopeful that we would come back in January and see better market conditions, and that didn't happen. We've come back to more volatility coming out of the Asian markets. We've come back to just an increasingly volatile world, oil below 30, and the investor base trying to figure out what that means. And so as we are focusing our time, first of all, there's been no U.S. capital markets issuance in shipping since last summer. We don't expect that there will be anything in the near term. And if you look at the valuations of all of the listed companies, even in sectors where the underlying fundamentals are quite strong, such as the tanker sector, there's been a lot of value lost in the equity markets, and much of that is due to the external broader market environment as opposed to anything company specific. But in this environment, investors are very much focused on balance sheets, capital structure, and which companies are surviving and growing in this market.
Yeah, so just to add a bit to that, in our experience, it's been a general sell-off in commodities and significant redemptions from basically all the energy and emerging markets funds that we typically see invest in shipping. In Bloomberg last week, it was an article about 4 emerging markets and energy funds who experienced $74 billion of redemptions in Q3 and Q4 15 alone. That forces many of these funds to sell liquid positions in what's deemed to be risky investments within shipping. And you see, as Christa mentioned, the disconnect between stock prices and steel prices. And across the board, all the various shipping segments are now trading at a discount to price to NAV or EV assets, if you like. That is obviously a challenging position for new activity for the existing players. It's even more challenging for new entrants considering to go to market. But it also creates opportunity where you can buy exposure in public names below what you could do in the physical market. So for those with cash, the current market, we think, represents good opportunities for those with the cash and risk appetite to enter at this point.
And I would just add maybe one thing is that investors are also very focused currently on liquidity, and I think Nicola's stats showed it. There is not much liquidity in shipping stocks, and so for investors to go out there and make a bet in shipping right now and not have real liquidity in the names they're looking to invest in, I think is another downward pressure factor affecting the stock prices across the board.
My colleagues having, or my counterparts having articulated why it's all so bad, I guess the question is what gets us out of this? I think I'd point to a few things. One is the stronger oil prices, and I don't think we need a $70 oil price. I think a $45 to $50 oil price would get a lot of activity coming back. And so I think, and I don't think that is something which is, it's not going to happen tomorrow, but it's not an unreachable goal. I think I think a lot of investment in shipping has been derivative of either the energy market or the growth of China. And I think the uncertainty and the lack of transparency as to what's really going on in China weighs heavily on shipping stocks as well. So I think that some sense of where China is settling out as it recalibrates its economy is going to be important. And then I would say, I would echo something that Todd said, but maybe with a slightly different twist, and that is that liquidity on balance sheets at this point is probably the most important aspect of getting from here to there as we wait for the equity market and shipping to recover.
Thanks. Well, as mentioned, even tanker companies, which have, we'll say, strong fundamentals at this point, are struggling to, maintain prices to their NAV. But how do public companies that need capital access that capital right now, or can they?
Well, I mean, fundamentally, if you're looking, we've heard this morning, I hate to be the Grim Reaper on the backswing, but we've heard this morning about what's going on in the bank market, particularly the European bank market. We've just talked about what's going on in the stock market. I think that one would say that the high-yield bond market is not in much better shape. I think that needing capital right now, that's why I really emphasize liquidity. I think needing capital right now is a real challenge. And so private equity firms are, by and large, private equity firms made their bets probably a little too early. So they're not jumping in. You're seeing some people who are deeply distressed investors coming in, but there's just, frankly, to my way of thinking, not a lot going on right now.
In my mind, there are two ways to raise money. Either a position of strength, meaning that you chase an opportunity, and it's a positive trigger for the stock, or a position of weakness, where you have to raise capital, otherwise you're out of business. And the way we see the current market environment, any asset has a price, and there's always money for good projects. But dependent on when you raise money, it depends on the terms you get when raising that money. I think if we look a bit at the various segments, there are essentially no segment that's currently in a position of strength, given where they're all trading, and meaning that the price that you would pay for growth is probably too steep, that you would like to sort of embark on that venue. When it comes to companies raising capital from a position of weakness, it's no hiding that the current dry bulk market indicates that all, maybe there's a few exceptions, but essentially all the publicly listed dry bulk companies will need to do something in order to sustain the current market. And at that point in time, you are a price taker rather than a price setter. So, looking at the various segments, we think that we might see position of weakness capital raises sooner than the other way around. That said, we have some reason for some optimism in dry bulk as well, just because we are at nominal historical low asset values, and you have what's deemed to be smart money in shipping buying into the sector today. And if you have a company that can turn their position from a position of weakness, fix their balance sheet, and become aggressive in a market where everyone else is sort of puking dry bulk stock, that's arguably an opportunity. That said, we don't think dry bulk will turn tomorrow, but you know, shipping is cyclical. We are in this business and only in this business. We don't try to raise money for telecom tomorrow. And we see opportunity, and as everyone in this room recognizes, it's always darkest before dawn. And the Greek shipping community especially has known to be cash buyers when everyone else is running out of the room.
I would just add to, especially on the dry bulk side, I think you know, some of the investors we talk to would love to invest at distressed prices, and they see companies trading at, you know, a very high discount to the net asset value, and you could argue the net asset value may be going down, and that's why. But they fundamentally can't say to their investment committees, I know dry bulk is going to turn in 6, 12, 18, 24 months. So to most investors out there that we talk to that either aren't in the space or maybe they already are, they're just having a hard time finding a catalyst to say, you know, in 12 months, this thing is going to flip and we're going to make a ton of money. So then you're left with what Karl said is defensive capital raises, right? So you have a lot of companies in the space. I think Nicola just showed 15 public dry bulk stocks with a combined market cap around 800 million. You know, what do they need liquidity-wise, to Eric's point, and how can they raise it if their market cap is so low? So if they need 100 million, but their market cap is 50 million, the U.S. capital markets generally wouldn't support that, right? So then it takes the current investors, and a lot of the U.S. public dry bulk stocks have big anchor investors, and the question is, will they put up the money to help get the company through? And then I think you could see, you know, new investors kind of latching on to those as long as there's support from some of these more anchor investors.
Eric mentioned that private equity may have jumped the gun and put their money in a little bit too early, but how do you think the current capital markets window is going to affect future private equity investments? Or do you think that private equity is essentially done with their investment, or that there's more to be had?
I think that private equity is starting to be more practical and realistic about what the exit opportunities are, and an IPO, and particularly in shipping, which is a cyclical sector and it always has been, but the IPO windows will come and go. I do believe that the bar to be a successful public company continues to get higher, particularly because we now have some larger companies within each sector, which do end up proving out that if you can be a sizable company with scale, with a good balance sheet, you will be the company that investors are drawn to. So I think that a lot of private equity firms are evaluating, instead of going public with their platforms, do they sell their fleets, for example. I think one of the challenges with that in today's market is that with capital being constrained on all sides, there may not be a buyer for an entire fleet en masse. So that's the conundrum, but I do think that this year you may see some shifts in terms of how private equity treats their portfolios.
I also think that whether it's private equity investors or others who are looking for liquidity in their investments, I think a lot of them do understand that the best path, given these discounts to NAV that we've talked about and other similar phenomena, the best path may be to become part of a consolidating company and to take stock that today is not valued where you want it to be, but if you believe that you are teamed up with the industry leader, to eventually wind up with the best valuation you can, if that's your chosen exit, or as Christa mentioned, it may be through the more, through the longer process, or at least the greater number of transactions of selling off pieces of your fleet, bit by bit. But I do think that the reason you see the consolidators with greater valuations is because there is this pent-up demand for liquidity on the part of funds that have limited investment lives to them.
I think we're partly seeing the answer to that question, because when dry bulk was one of the after product tankers, dry bulk was the segment to attract the most private equity interests and investments. And what you did see was that every private equity firm probably flew to Norway, Greece, and a couple of other places, and teamed up with what they deemed to be the best dry bulk partner. We ended up in a situation where you have a lot of private and still private equity joint ventures, or call it failed OTC placements who never managed to migrate to a more liquid exchange. You then had tankers, which started to attract at least public capital, and you saw that private equity was noticeably less active in finding sort of their own setup, but rather investing into the public entities, because they acknowledged that they had probably been a bit too aggressive on the dry bulk and ended up in illiquid position. And private equity is not as long-term owners as any ship owner. So thereby, I think they learned from what they did on the dry bulk and have been significantly less active in private equity joint ventures on the tankers. And if you look to other segments, which is even higher demands to operational excellence and technical standards, such as LNG, LPG, and so on, there's literally been no private equity joint ventures. So it's typical that the lowest barrier to entry, arguably operating-wise segment, dry bulk, is the segment that attracted private equity first. But you've seen that they've not been nowhere near as active in any of the other setups, and they've completely failed to seek liquidity on the dry bulk before it's arguably too late. So I think that private equity has definitely learned a big lesson, and I very much echo the rest of the panel that size and liquidity is primary barrier to entry of going public. And we used to say that you needed to be a $500 million market cap within 6 to 12 months to have anything to do in the public markets. And now we think that bar is raised to at least 1 billion because you need to provide the investors with liquidity.
Taking that positive note a little bit further, so assuming that there is a slight window for an IPO, which it sounds like for the I don't want to put words in your mouth, but for the time being there isn't. But if their window were to open up, in the next, we'll say 12, 24 months, whenever it does, besides scale, size and liquidity, is there anything else, some other characteristic that companies need to have or should have in order to potentially access the capital markets, or is it really just a size barrier?
Okay, so if you're going to be listed, you need to think about not necessarily what's best for the company, but what you offer investors vis-a-vis what's already out there. So if your plan is to copy-paste a company that's already listed, your only competitive point is price. And you will lose out if you're the new entrant, because it's always easier to buy the one that's already there. So if you are to be listed, you need, and not just have a price as the only argument to go to market, then you need to differentiate yourself in one way or form. Take one example from the product tanker space. We have been actively backing 2 different platforms with 2 different or arguably different exposures. One company that we've been actively working with is Scorpio Tankers, whose eco new builds, spot exposure, and low financial leverage. So high operational leverage, low financial leverage, and new assets. Another setup we've been actively backing is Navios Maritime Acquisition. That's, to the contrary, assets on the water, older ladies, around about 10 years, high financial leverage, around about 70%, fixed charter coverage with 50-50 profit splits that sort of add spice to the mix. then that's a different exposure than the same investors that, or than the investors that seek Scorpio tankers exposure, and thereby you have differentiated your company. But if Navios were to do new builds only, but only half of the fleet of Scorpio, less liquidity, then obviously they would price at a discount. It's quite natural. So I would think more about what can you offer the investors and what differentiates your company, rather than just seeing where the window is.
I would also add that management track record, credibility, and corporate governance all go hand in hand with a successful company in the public markets, because public investors do have a skepticism, to be honest, of the shipping industry with respect to how different individuals can profit from the public markets. And so I think time and time again, you have seen sponsors of public companies who have had multiple public companies who have been good stewards of capital and building up that investor trust. And that can be privately through what you have built as an organization, and it also can just be building up that reputation with investors, but I think increasingly that matters.
Yeah, I would just amplify what Christa said, and I think that if what is taken public is merely the asset financing function of a company that otherwise has all its intellectual capital and know-how elsewhere, that's a formula that has become less accepted than it used to be.
I would just add, I think talking about what would maybe first open the market is something maybe that isn't bulk shipping, right? So something that has a real industrial play behind it, where I think part of what has hindered the capital markets for shipping companies lately is investors don't have a lot of confidence in forward earnings, right? So if you get to maybe a chemical sector or the gas sector, if industry fundamentals are there and there's real demand for the assets and there isn't a clear oversupply of the assets, I think and you can start seeing a little more visibility into earnings. I think that could be the first type of company that could reopen the IPO window.
All of you have just mentioned kind of at some point, what the investors are going to want, or how the investors are going to react to certain things. But taking that a little bit backwards, what do investors of current public companies want right now out of their companies?
Higher prices. Seriously. I mean, that's in a nutshell, is that people have lost a lot of money and people will come back to it when they make money. And so it's very simply that. And that's not the quote unquote fault of the companies in many occasions. It's a combination of perception of the industry. What Isabella and Christa both mentioned is there's been no activity in the market overall. So this is not just a shipping issue, but it is perhaps well accentuated in shipping. But people need to make money and be able to go back and say, I made money out of this investment, I'm reinvesting. I'm not just taking new money and throwing it at a sector where I've lost money.
I would add to Eric's comment, and also something that Nicholas said in his opening remarks to this panel, which is, in today's environment where there's so much uncertainty in the world, what investors want to see is communication from the existing public companies. And this is not an environment to be hiding. This is absolutely an environment to be communicating out with investors on non-deal roadshows, explaining why nothing fundamentally is wrong with your business, because you see across industries, whether it's shipping, whether it's or energy, more broadly, a lot of uncertainty with respect to what management teams may do. And so I think that constant communication through these times is critical.
Yes, on that, do you think there's a current issue of transparency? Or is this something that you think is just generally for all public companies? Or is it something specific about the shipping industry in particular?
Oh, my comment wasn't referring to a lack of transparency. It was more just being out there speaking to investors with respect to being available to answer their questions, being in front of them proactively. I think as a general matter, the public companies do a very good job with respect to their ongoing obligations with investors, but it's in these times that you really have to do more, even though it feels like, there's maybe nothing to say.
Well, swinging back to something that Nicholas started off with, which he said we were going to touch upon, so I guess we probably should, lest we not be invited back. Where do you think, do you see a future in MLP structures?
I think the MLP structure, I've always thought of MLPs as a line on the balance sheet, that it's really a way to finance a portion of the assets that have very specific characteristics. And MLPs work so long as you can grow the distributions, and then they don't, and they work very well in that case. I think that it's going to be a while before we see any new MLPs. I think that there's a good chance that MLPs may be bought in by their parents. I think that the MLP sector, you really have to think about it not in terms of shipping, but really in terms of an energy sector. And it's an energy sector that's that's obviously a yield play for investors. And if you think about everything that we've talked about, everybody talks about all the time with regard to where have commodity prices, specifically oil prices, gone, it has not been a place where you have been able to grow distributions. And so therefore, I think there's going to be a whole recalibration of the MLP sector.
And I guess this one's for Karl probably more than anyone else, but do you think that their Norwegian markets are going to turn? Because there is, as you mentioned, kind of the OTC market doesn't have the trading that one would typically like in a public company.
Yeah, so I think there might be a common misperception that it's a Norwegian market and it's a New York market and I don't know, it's a Singaporean market. That's not true. It's one financial market for the most part. There are certain funds who have mandates only to invest in Europe, for example, that you cannot tap into if you're listed in New York, and some of those you can cater for in Norway. But let's be honest, we have raised 47% of all public equity for shipping from 2013 to date, and the vast majority of the money we raise comes out of the US, regardless on whether or not it's an OTC placement in Oslo or it's a full listing in New York Stock Exchange or a follow-on for that matter. So how to think about Norway, both the Norwegian Stock Exchange and the Norwegian OTC? It's a way to capture market windows in a significantly swifter manner than you can do in any other exchange in the world, and still being recognized as a sort of thorough exchange by the international investor community that invests into shipping. So I don't think that the Norwegian market will sort of open or close anytime before or after, for that sake, the US market. But what I do think is this: as long as all the public names that are there and have been present for a while are trading at a discount to steel value, no one in their right mind will introduce a new company with the exact same exposure on a less liquid exchange when all of your peers trade at a discount, because that means that you don't have any competitive advantage in terms of track record or liquidity, so you have to go at a discount to where all your more liquid public peers are. So the short answer is no, I don't think the Norwegian market will be more active than the New York market. I think less so this year. But when you see opportunities arise in sort of frontier markets, such as some of the developments we see on sort of investing through the supply chain in LNG in particular, the OTC market is known to be swift and have a very shipping knowledgeable investor base that can grasp opportunities very quickly. Also, the cost of being listed there is still lower, but if that's your major issue as a listed entity, the cost of being listed, you probably shouldn't be listed, right? Because, yeah.
Thank you. I know we have a little bit more time, but in light of the fact that we are between this panel and a couple others and then drinks, I understand that there are other people and we are fairly behind schedule. I guess we'll open up to questions if there are any.
Yes, I'd like to ask a question. You can hardly pick up an issue of the Financial Analyst Journal, Barron's, The Economist, that it doesn't have an article relative to the attractiveness of cash dividends or share repurchases. Which do you think shareholders value more highly?
Yeah. So the question is, which do shareholders value more highly, cash dividends or repurchasing of shares?
I would say in today's market, investors will value share repurchases more than dividends, in light of the fact that dividends have always been an interesting debate within the shipping sector. And I think we've gone through some cycles even with respect to how advisors will talk about dividends. But I think, today dividends are important. We believe that they are, but we believe that they are important in the context of overall capital structure. So they have to be sustainable in terms of paying out cash flows after servicing your debt and your capital structure and thinking about amortizing your fleet. If you look at the dividend yields across the shipping MLPs, they're trading north of 15% today, when historically they traded between 6 and 7% for the LNG MLPs, as an example. If you look at the tanker sector, which is down 30% year to date, the dividend yields are also quite high in the high single digits to low double digits. And so one could argue that investors in the current market are not rewarding companies for increasing dividends. Is my view. That said, I think dividend cuts can be signals of lots of things and should be carefully considered. So I'd say in today's market, if there is excess capital to prioritize and your stock, which pretty much all of them are, is trading well below NAV, I would prioritize share repurchases over dividend increases.
I would say that if you are generating excess cash, I think depending on what sector you're in, but certainly there are a couple of sectors in shipping where I would keep that cash. That cash is really, really important, and I wouldn't be paying it out. And if all of us are in the banking industry, and I remember not too long ago when there were banks that said, "Oh no, we're not going to sell equity at these prices, or we're going to make some statement to the market about how strong we are." And the best thing they could have done was to have cash on their balance sheet. So I really think that candidly, we're in a time when a lot of people don't want to hear about sort of how, I agree with what Christa and Nikos said, which is absolutely important to be out there in front of investors and everything like that. But I think you got to understand that there's a lot of momentum pushing against you, and so you have to act out of self-preservation. I think having cash on the balance sheet is just really important in certain sectors in particular.
Yeah, I think Eric and I have gone back and forth on this liquidity thing, but I totally agree with his point. And then on top of that, a share repurchase, which I guess theoretically investors may value more, given the lack of liquidity in the names already. You're essentially sucking some of the liquidity out of the stock, and so I'm not sure that's the best route. I completely agree with Eric. Cash hoarding is okay, and deleveraging is okay.
Just a few comments from my side on dividends. First off, I think a dividend should be return on capital and not return off capital. You see some shipping companies in cyclical industries with spot exposure committing to a fixed dollar amount of dividends, which honestly I think is a very bad idea. So as opposed to having a fixed dollar amount, you should have a percentage of net income. The percentage of net income should reflect your financial position. So if you have 70% leverage, obviously you don't pay out 100% of net income. But if you have low leverage and a sustainable cash break even, we see in the market that 100% dividend is what investors really appreciate. So to answer your question, and it's a very good question, the responsible capital allocation, or the right answer, if you like, is to say that whenever you're trading below NAV, the right answer is to buy back your stock. And whenever you're trading above, you should pay dividends. However, as Todd mentioned, buying back stock takes out liquidity, and we think over time it's proven that companies with a sustainable dividend policy are priced better than their peers. It's just to look at sort of facts. So this summer you had Euronav stating that they would pay 80% of net income in dividends. 2 months after, you had DHT saying they would pay 60%. If you look on the relative performance of the two stocks thereafter, Euronav's outperformed. If you look at two other tanker companies, Frontline and Nordic American Tankers, they pay out 100% dividends. And whenever rates spike or go up, a couple of thousand, that's the names people buy into. And if you look at NAT, which arguably has a very different shareholder base than all the other tanker names, they are the only tanker name that's trading consistently at the premium to NAV, because they are focused on dividends. However, they are also, in bad times, return off capital, meaning raising equity or raising debt for paying dividends, which we do not think is a good idea. But sort of to summarize, I guess, the view of the panel is that you don't pay dividends unless your balance sheet allows for it. Where we maybe differ a bit is that I think over time that you get a better pricing if you return capital to shareholders when times are good and stop dividends when times are bad, with the rationalization of that there's no net income to pay dividends from. And that's sort of the model that you've seen John Fredriksen apply to all of his companies very successfully, and he's obviously got quite a good investor following, even in bad times.
I think we have time for one more. I saw in the back.
You hear me now? Okay. My name is John. I'm from ITCM. I have one question. You discussed about lack of liquidity to small companies, compared with the fact that the current dry market is depressed. We see very low asset values. So I want your expectation, your prediction about the future of companies who are actually the backbone of Greek shipping, operating 4 to 5 vessels, let's say bulkers. What do you expect that will happen to them, and what is your suggestion about their survival, let's say?
I would ask what their balance sheets look like, and I would hope they have a whole lot of cash and not a lot of leverage.
Yeah, I think that the future is likely that those companies remain private and probably operate with less leverage than historically. But I don't think you're going to, when the IPO windows come back, you're not going to be seeing the smaller companies lead that window.
Okay, and with that, thank you all very, very much for your time.